Welcome. Today we're going to be covering a bit of theory. We're going to focus on the objective, scope, and very importantly, the definition of revenue encapsulated in IAS 18. So bear with me, some of this is a bit boring. We need to get through it to give you a good base for the rest of your lectures. So taking a step back right to the conceptual framework for financial reporting, the income, not revenue, income definition per the framework is based on an increase in economic benefits, i.e. an increase in assets or decrease in liabilities, okay, which will equal an increase in equity. And here they exclude specifically other than contributions from equity participants. Okay, so that's where everything is based from, guys. This is the framework. Okay, but again, the framework goes on to say income includes both revenue and gains. And then it goes on to separate what is the difference between revenue and gains. Revenue is from the ordinary course of business, where gains are not ordinary. I.e. revenue, if you're buying and selling CDs, then the selling of CDs would be your ordinary activities. Okay, but if you sell your factory or your warehouse where you store all the CDs and you make a profit on that sale of building, well, that's not ordinary activities. That will be other income, not revenue. So to get started, I need you to understand what is the primary issue when accounting for revenue. Okay, you'll find later on the measurement's quite easy, classification's relatively easy, but the question that will always be problematic is when to account for revenue. Okay, and here I need you just to conceptually think about accrual accounting. You will account for revenue in the period in which it is earned. Okay, be practical, always use a timeline to get the correct period. You don't want to make a silly mistake because you're thinking about the wrong month or the wrong day, etc. Scope, IAS 18 paragraph 1. IAS 18 shall be applied in accounting for revenue arising from the following transactions and events: sale of goods, rendering of services, use by others of an entity assets, yielding interest, royalties, or dividends. Okay. There are other revenue standards or revenue types that are not included in IAS 18. You have, for instance, revenue from construction contracts. It has its own standard, IAS 11. Then there are some IFRICs and 6 that will help you clarify some of the issues described in IAS 18. The one that we will discuss most often is IFRIC 13 on customer loyalty points. But again, that's not within IAS 18. Okay. Then it specifically, IAS 18, paragraph 6 specifically says, or tells you the scope exclusions. I need you to read through these, but it goes on about lease agreements, insurance contracts, dividends arising from investments, from equity accounted investments, etc., etc. I've listed all of those there for you. Please read the standard and look at my notes to make sure you understand that things like biological assets have their own standard, IAS 41, etc. Okay, so jumping back here, revenue definition, paragraph 7 of IAS 18. We've touched on the concept of revenue. Here we're talking about gross inflow of economic benefits during the period from ordinary activities, which will result in an increase in equity by either increasing assets or decreasing liabilities, and it's not related to contributions from equity participants. So once again, what is the big thing that's different to the normal framework definition of income? Well, it is the inclusion of this term ordinary activities. That's all the classification requires. One thing I do also just want to jump up here is that we are also going to talk about gross inflows. Okay, and let's just clarify some issues there. Only the gross inflows received or receivable on the entity's own behalf or own account are included in revenue. Okay, so what do I mean here? If I sell something and I include an item of VAT, for instance. So let's say the selling price, excluding VAT, equals 100. What will my journal be? Well, therefore, including VAT, what will I do? I will take the 100 times 1.14. Let's assume 14% is the VAT percentage. Will give me 114. What do I recognize as revenue? Do I recognize the 100 or the 114? Well, the extra 14 is not receivable on my own account. That's for the tax authority. So VAT will be excluded. So I'll do something as follows. I will go debit bank with the full 114, credit revenue in profit or loss with the 100 that's received on my own account, and then I will have a VAT output or VAT control account that will be in financial position, the balance sheet amount of 14. Please take note, this revenue is in P&L, whereas the 14 is owed to the tax authority, and that is a financial position. More specifically, it is a liability. I owe that 14 Rand or dollars or euros across to the tax authority. Great, so this is just a base for you to start from. We're now going to work through very limited, short bits of theory with lots of class examples which you will need to do practically. Please work through the rest of this video series. Thank you.